So this is a little different take, right? Because we're going to get a lens of following the capital, and we've got a great panel here. And as opposed to me, trying to rehearse what it is to say about each one of them, I'd like for maybe Lee, you start off with brief introduction, talk about your fund, what you're focused on, and then we'll hop into it.
Sure. So my name's Lee Haney, Greylock. We're first check investors, so we're trying to find founders oftentimes in their last job before they've thought, like maybe sometimes even thought about what they're going to build next. So we've initiated companies on whiteboards in our office like Palo Alto Networks and Workday, more recently Abnormal Security. So it's hopefully on the front end of a lot of the AI exploration, which means we're stumbling through the dark, probably like everybody else.
James.
Hi, James Higa. I started my career at Apple, was there for 28 years, reported directly to Steve most of that time, running special ops is the best way to describe it. Small secret projects that you've come to know as iTunes, iPhone, iPod, et cetera. Went from there to Index Ventures, where we made investments in companies like Figma, Slack, Scale.ai, et cetera, and started my own firm. Offline Ventures is where I'm at right now. It's an early stage firm, and I love the early stage where ideas are fragile and you can make a big impact.
Mike?
Same. Yeah, we like early stage too. Hey, Rich. Mike Dauber. I started my career as a real operator and moved into venture about 18 years ago at a larger firm called Battery. My partner and I there kind of saw a trend late 2000s, early 2010s, that there was this shift of, the old startups used to be kind of the, as my partner calls it, the 42 long CEO, right? Former GM at Cisco, former, VP at Oracle, and then you'd find some technical team behind them, and that's what all the startups were doing when I was at Battery back then. And we saw a big shift from kind of the 42 long to the technical founder, where the technical founder could take the company the distance and be the CEO of that business. So we left to start Amplify Partners, not Ventures, by the way, in 2012. And we've been rocking and rolling ever since. So we're on our sixth fund. We're a $400 million fund. And my favorite little Amplify story was, when we were doing our fundraise, I think our last at-risk fundraise was 2015. We were pitching LPs on $1 trillion in market cap was going to shift in the next decade because of cloud and AI. And we got laughed out of at least half the rooms because people were like, why aren't you investing in companies like Airbnb and Uber? And it was a lot of fun to raise our next fund in 2018 where those same LPs were trying to come back to get allocation. Anyway, excited for the talk.
Great. So Gamil Gran, I'm with Mayfield. We're a long-standing venture capital firm, so thank you for having us here. Richard, amazing event. Cliff, always amazing. KPMG team have done an amazing job. We, as a venture fund, are one of the old firms here in the Valley, or in the Valley. We're on our 20th fund now. I have created this fascinating job for myself in the venture world. I've been in the venture world for about 20 years. I got to know Richard when he was a CIO as an operator, and one of the roles that I get to do is bring our technology companies that are young and raw, and I'd love to get into this in some depth here, and share them with CIOs and IT leaders who are eager to learn and leverage technology in a really important, impactful way, but frankly lack some of the skills in working with startups. So I have this, as I say, fascinating opportunity to spend time with our 80 or so companies in our portfolio. These are young entrepreneurs, often premature on their product market fit, don't have ICP really realized, that ideal customer profile and persona. So I get to spend time helping them focus and do so in a way that's capital efficient. And I've been doing it now for 20 years, so thank you.
It's great. Obviously a very esteemed panel here. And so we'll start off with maybe the investor horizon. Gamil, we'll get to working with CIOs too, for sure. The pace of technological change, AI, solutions are becoming obsolete overnight. And that obviously has to change your investment horizon, how you're looking at companies, how you're picking, what you're looking at in the future. And so maybe Lee, if you want to take that one on first. How has it changed in the last year?
Well, and as fast as it has been going in the last year, it's about to get a lot worse. So, last 2 years, it's been a dearth of IPOs and returns to our LPs, our investors, across the market. So something we haven't talked a lot about this conference is all the IPOs are coming. Like today, Figma is now trading $20 billion market cap. VCs own 55% of that company. So that's $11 billion that's going to be plowed right back into startups as soon as the lockup period ends. Yep. So if we think there's a lot of capital flowing into the space right now, it's only going to get more challenging in that regard.
Yep. James, do you have a view on this? Has your investment horizon changed? Have you taken a different lens as to how you're looking at companies?
Not a different lens in the sense that we're an early stage firm, so many times product isn't even there, and we have to decide on founder quality and ideas. For me, ideas with a capital I. We're talking about Figma. When I first met Dylan, I think he was 19, very small team. Had a crazy idea about we're going to do what Adobe does online with some collaborative effort. And I think common wisdom at the time was you cannot go take on an incumbent like Adobe and let alone go straight for the heart. But Dylan sat and we talked for maybe 2+ hours about browser rendering technologies and algorithms and new techniques and math. And it was clearly a founder who didn't just have this fuzzy idea. He had a very crystal clear idea and how to get there, and the engineers he needed to hire. And well, like, who are you going to hire? I'm just talking to an engineer at Google that I'm going to sign. Wait a minute, you're 19 years old and you're actually going to steal a 40-year-old engineer out of Google? You must have a compelling vision. You know how to communicate it. You have charisma. But what's really changed, I think, also on the pace is the compression of the due diligence period. For us now, it's kind of like skip the deck and all that. I'm kind of sick of looking at decks because all of it's AI written now, and we can tell. But the problem is, like, I don't know whether the founder understands the idea that's on the deck or whether it was the AI's idea. So I just want to skip the deck. A recent AI startup I invested in was someone I worked at before, was at Good Eggs, went through that whole deal, pitch, investment period, IC committee, 1 year will help you design, get the product off the ground. This time he came in and said, here's the app I wrote in the last 20 days. It was polished enough to go into the App Store. It's that compressed, just show me what you got, write it. The pace is just increasing from the starting line. And we're going to have many, 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 many more startups on the line.
Sure. So Mike, maybe talk about how you're discerning those that are more hype-driven and maybe riding trends versus those that have truly distinguishable,
So our model has always been to get to know people truly years before they start companies. I think it came out yesterday that OpenAI is their entire write path is now on top of a database called Temporal. We knew the Temporal guys from early in their journey at Uber, probably like 2 years before they left to start the business. So when you get that much time with a founder, you have a really, really good sense of what they're doing and the reality of that. Doesn't mean you hit on everything, but I think for us, it's the random pitch that you see on a Tuesday or a Wednesday is unlikely to be the company that you're going to go invest in if you've never thought about that problem or that person before. But I was going to say, just hitting on the question you started out with, I don't think we're seeing the time horizons change, right? Early stage venture, you got to expect that you're going to be with that company for 7 to 10 years. I think the thing we really think a lot about is just the durability. I mean, you're seeing companies like Lovable, companies like Cursor grow faster than anything we've ever seen before, but VCs love to look at things like net dollar retention, and most of these companies that are growing really quickly, there's just no retention data when you're looking at these growth rounds. And by the way, we look at growth rounds for our own companies, right? But when we look at these types of businesses, it's very, very, very hard to tell how much of this is companies that are using this product for something in production for a long time, or it's, hey, we got to try this AI shit out somewhere, and let's try this out. Like I saw a tweet last week that I kept thinking about, which I think Lovable got to 100 million in 8 months. And he was like, I haven't seen a single application anywhere that's actually made by Lovable. So where's the 100 million going? Right? Is it all just going to be a flash in the pan? And I'm not trying to knock that company, but just in general, we think a lot about what's the durability of these businesses that we're seeing.
Right. And so Camille, you talked about your experience over many years. Talk about, are you seeing differences in the founder of today versus the founder of yesterday? And maybe speak to that.
So many things are changing. But at our core, our first principle as a firm has always been people-first investing. Early stage, lacks a lot of the quantitative data. In spite of a made-up PowerPoint, generally it's a product that's premature, that hasn't actually been realized. There's a TAM thesis that hasn't fully been realized. So of the 3 T's, we over-index in the team, the founder, and that principle hasn't changed. But there are some macro principles that are changing that are focusing or forcing us to change the way that we go about investing. And one is just broadly the surface area is much bigger. I think Mike talked about the $1 trillion LP conversation he had a few years back. It's a $6 or more trillion opportunity from a dislocation standpoint right now. We think the entire IT stack, everything that everybody is spending on today, is going to go from its current design, everything from the x86 data center environment, all the way up to the full application stack, and then a new stack on top of that that'll be agentic based. That, we believe, is the macro translocation or dislocation that's occurring. That's causing, of course, entrepreneurs to come out of large opportunities that they're currently running, organizations, et cetera, everything from tech companies to traditional John Deere sort of organizations that are saying, hey, I've got an idea. So the broader sort of surface area and across the entire stack. This is encouraging LPs, our traditional LPs, and we're on our 20th fund. We have a traditional set of LPs, 67 or so of the major institutions in the world. They're coming back to us prematurely saying, hey, we want to plow more money in at this market. So there's more capital coming into the market in addition to the Figma distributions that Lee talked about. So there'll be more capital, more entrepreneurs, and the entire stack being remade. Of course, we need to change our strategy to be even more aggressive. So we're expanding the vehicles with which we're investing in. We're going earlier. We're going to universities, working on research projects. We're going later into markets where there's actually revenue that's been captured in some sort of meaningful way. We're going into markets that weren't opportunities before. Some crazy markets that essentially didn't have access to technology previously. Just a really crazy idea, a company called House Whisperer that we just invested in that takes the role of a real estate agent and automates it with the idea that a real estate agent tries to pretend to be a big operation, but it's generally a single individual or a small firm. Previously didn't have technology teams accessible to them, but with agents, they can actually automate a lot of their tasks. To us, that's an expansion of the surface area. So, yeah.
We touched on a little bit through the symposium about the ongoing debate of the big tech enterprise providers that are out there today versus the AI startups that are coming in and going directly after large corporate clients and the like. How are you thinking about that new interplay and who wins and balancing it?
Well, one thing that's kind of hard right now is to determine who is an incumbent. NVIDIA is not a new company, but they are disrupting the big cloud providers. They're blitz scaling in a way that you would think of a startup trying to, we're just going to invest in this massive amount of growth. So I think there's a lot of questions right now, what is, aside from maybe some of the obvious examples, what is an incumbent in this space? I mean, displacing Cursor right now might be a challenging thing to contemplate. So that dynamic is very, very challenging, I think, for an enterprise to consider is hey, my first deployment of a Cursor may feel like a very new thing. But the question of, what should I try the next thing beyond this? It's hard to compare, and we're going to get into this more later. I know, just being able to sift through all these different questions.
Right. Are there certain markets or products, James, that you think are more susceptible to that the large enterprise players maybe are at risk on?
Yeah, kind of think about it. One, at the high level, you kind of touched upon it, which are the world is really going to change, as we've talked about. And so I think incumbents, large, small, it's not going to look like that. There are going to be large LLMs. There's going to be finely tuned LLMs. There are low resolution LLMs, and it looks a lot more like LLMs, vast amounts, agents, talking to each other, transactions. So for me, the more interesting layer is that orchestration, coordination layer. The internet was built on a communication protocol, TCP/IP, but I think we're entering this age of permission protocols. So it looks like a much more chaotic ocean out there. So I think that framing needs to change, for one. Where we're seeing some areas that I've seen with startups that have an advantage is, I don't know what to call it, maybe it's the collapse of the business. We invested in a company called Worthy that does underwriting for SMBs, but based on invoices, against invoices rather than assets. Yeah, good idea. Probably an investment 2.0, we would have done it. But this time, the two founders literally were working for an investment bank that literally had like 12 stories. Each story has, each floor does a different part of the underwriting. They've essentially collapsed every single floor into one agent. And the agents talk to each other in a Slack channel, actually. You can watch it. And they're going through all the steps of the underwriting and then coming up with a yes, you should, or no, you shouldn't. And the two founders decide. So this is like a collapse of a whole building into one little thing.
Right.
And I think we're going to see kind of more ideas like that. But it's an area where I think the incumbents or the big foundational models can't really play in. And the other area is kind of, there are unique models that are very different as well. We made an investment in a company called Atmo, which is like a weather 3.0 company. And they, instead of NOAA's supercomputer weather model, they run 12 different competing weather models against each other. SpaceX uses them to determine their launch dates because of the wind prediction accuracy is so much higher. But the difference being they have their own models for weather, but SpaceX has their own local sensors that feed into that model. The Air Force uses these models. The Air Force puts proprietary sensor data in. So again, this notion of very highly collaborative, meshed entities is, I think, another area that's very different that I would put more on the startup-y side than the incumbent side.
Right. Camille, we touched on, as we were walking up here, if I'm the CTO or if I'm in the boardroom of a large company, I need to have a entirely different interface with the technology providers and the options that are out there.
Yeah.
What does that look like to you? And these are organizations that are going to have to go through massive change in order to start to interact with companies that they've never interacted with before.
Yeah, so I mentioned before, we think the entire IT stack is going to get remade. We're only beginning. Some people use the baseball analogy. Where are we in the baseball 9 innings? I think we're just getting to the parking lot in some ways. So in many ways, I think this is still very early. But if you think about if I'm a traditional CIO, CTO of a large organization, I have a portfolio of assets, and I'm rationalizing, are these technologies going to take me to an AI-first agenda? And so you'll spend time with your existing portfolio of providers, and will they re-architect their platform? Great. Will they add a co-pilot to it? Great. But I think there's another innovator's dilemma that is also a key piece of this thing. The startups that we'll invest in that'll be AI first, let's say in architecture and design, will also have an opportunity to change their business model. They can change the way they license the product to be more outcome-based. And just think of negotiating, I don't know, your next CRM agreement and saying, how many reps do you have versus how many sales calls do you create for me? And in some ways, that is another logjam, I suppose, that the existing legacy of technology vendors will have to face. And so if I'm a CIO or CTO, I'm going to look for that roadmap and say, where are you taking us? What are you doing to transition us to an AI-first environment? What's your roadmap? And will you just continue to be a system of record that charges me for owning, managing my data, or will you actually create productivity and outcome? The thing that you and I talked about is I think this is sort of game on for a CIO or CTO's organization, that you can't just pretend to be thoughtful about innovation. You really have to be best in class. And I think it's not just best in class, but relative to your peer group. If I'm a startup, will I work with you or will I go to your competition because they're easier to work with? And being a design partner with one of these early stage companies is, I think, a best practice because you can help engineer that product to be more purpose-built for you. And so, wow, what a double win. You learn faster. You're leading edge. You're doing so before your competition, and you're designing it with your direct needs in mind. But boy, you got to have a game to do that. You got to know how to do that well. And we talk about innovation and best practices, and people have showcase events and all sorts of things. I'm like, it's got to be a real integrated process. And in the previous panel, Tammy was talking about how, I guess at John Deere, they've put a technologist in between the business unit to really be sort of the whisperer, if you will, to help make that happen. I think that's a best practice. So.
Yeah, Mike, maybe you can take it from the founder's side, right? How are you working with your companies in approaching companies that maybe they wouldn't typically 10 years ago have approached as early a stage?
I think we talk a lot about technology stacks and how technology stacks change over time, and that's kind of where venture has an opportunity, right? Think about what happened in mobile, think about what happened in cloud. But I think the thing that changed in cloud, if you were, an on-prem application, you really struggled in the cloud. And the reason why we saw a lot of IT shift to the cloud, I think, was because you were empowering the line of business owner to go drive their business. It's a little bit different this time in AI, right? Like you saw that, I don't know if anyone followed like the Glean Slack dynamic a month ago. For those who don't know, right, Glean was pulling data out of Slack until Salesforce put their hand up and said, no mas. I think we're going to see a lot of that over the next couple of years, right? So whereas Salesforce's, I think, fundamental value prop in the early days was don't rely on IT to go do a Siebel install, right? Today, if you're running on Salesforce and you want to go do, and I don't have a CRM company, so I'm just, imagine Nuco CRM that wants to pull all your data out, Salesforce is going to say NFW, right? And so you are going to have to pay this management tax for a while. Who's going to get off Workday tomorrow? I think what's been interesting for us in AI is it's the other stuff that they've been able to go after. Forever in venture, you knew not to go after defense. You knew not to go after healthcare. And I don't mean healthcare like bio. I mean healthcare like IT spending. Legal. Was it Service Titan and was like the exception. Now you see a whole slew of home services companies. These are all businesses that we in venture ignored for the 2 decades I've been aware of it. They are ignored no longer, right? The number of legal tech startups that I've seen has exploded. We have a very, very, very large LP of ours who's a big insurer who will no longer work with any AI-funded legal tech startups because they basically believe that they're offensively attacking their auto insurer, right? Because the cost of basically creating a claim against an auto insurer has gone from expensive to zero because of some of these startups. So they're basically like, this is an arms race and we're just getting attacked. So we're only going to invest in companies that are helping us defend and not attack. And so I think the next few years you're just going to, coding aside, it was sort of obvious to us that you were going to see a lot of folks like Cursors come out. I'm seeing a lot more exciting stuff in the other verticals right now. I think the core of IT, when you go up the stack in applications, is going to have to sort out because I don't think that Workday and Salesforce at all are asleep at the switch. I mean, ServiceNow, I mean, those companies are not giving up their mantles anytime soon. And if you're a startup and you're like, hey, look, I have a lot of cool things I can do for you. All I need is your data, right? Mm-hmm. Good luck.
Right. And James, maybe you can hit on it. At some point, right, the companies are going to be overwhelmed with the number of companies that they're being approached by. And, right, the Workdays, the ServiceNows, they have, right, the data. They're there already. And so maybe talk about how difficult it is to displace that and to really gain traction in this AI age.
Let me reframe that in terms of, I'm a product guy, and so I kind of look at the whole ecosystem as I hope we're entering an age of more radical collaboration between startups and between enterprises, between incumbents like the Workdays and startups. The way we've approached it at Offline as the fund is a product. And what does the world look like out there? Mm-hmm. The IPO window's starting to open up again, but still a lot of exits have been to the big Magnificent Seven and incumbents, et cetera. Private companies are staying private longer. And so we've come up with a studio where we create our own products. We don't bring founders in. We started 138 products in a couple of years. We have 30-some going right now. But I think the interesting part for this audience is in terms of kind of innovation and getting traction is we've had interest from companies and enterprises wanting to work with us as part of their innovation engine. And we've had Fortune 500 companies, we've had healthcare companies come in and say, could we do this together with you? Could we invest in having the potential of being the first in on 5 of the 20 projects that you're doing in essence. So I think we have to really think about this radical, collaborative, different way than we have been thinking is rather than let's attack the incumbent fortress and who's going to get traction, et cetera.
And so how do you build, and any one of you as we're getting closer to wrapping up, how do you build trust, right, through these solutions with the buyers? And, right, you're going into large corporations. How do you build trust that they're going to rely on your portco as the case may be?
One part of this is as much as we talk about people being replaced, this is still like all about the people. So, yesterday we heard John Maeda talk about how Jerry Lou's the GOAT of RAG. That's social proof from someone who knows. Maybe I should spend time working with that person. And I think it's a little bit of a tire cliche to think of a startup as like people building in the garage. These people are world-class, engineers in what they built in their prior lives. So when we think about, hey, I'm going to work with a large incumbent. All right, I'm buying a product. If I'm going to work with a startup, I'm going to work with a Jerry Liu. I'm adding a member to my team who I can help drive and influence where that product's going to go. So that trust building, I think, it's a lot more closely related to kind of a leadership management relationship than it is a vendor customer relationship with these early stage firms. And you get very, very close, and then you can build a lot of trust there. Yeah. On the other side, there's a big gap currently still in terms of the entire stack for data management, governance, privacy around operating for AI does not exist. There's initial work being done in it, but if you're a large company and you want to share access or you want to try a new product, but they say, hey, give me God level access to all of your sensitive data, of course the answer is, or almost of course the answer is going to be no. But if you can create, and I think the onus on this case is on the enterprise, if you can create the ability to engage with the right data to prove, hey, this is going to work or that's not going to work, now you can POC 3 competitors against each other versus, hey, I don't even know if I can POC 1 because I'm just not comfortable with it.
Yeah. Mike, it looked like you were going to add on to.
Yeah, I think it's really, really important that with this technology in particular, that you're building trust with your customers, right? It's always obviously important. I was in sales early in my career, and you couldn't sell anything if your customers didn't trust you. But with AI in particular, just because of what an agent can do once it's within your infrastructure, you have to demonstrate to people that it does what you think it's going to do consistently. Otherwise, no one's going to deploy it anywhere, right? There's just enough horror stories of people, the Air Canada chatbot, right? Gets the wrong answer, and then the court finds Air Canada is liable for the answer. Yes. Those are relatively benign compared to, we worry about having bad actors internally in a company, right? This isn't necessarily a bad actor. It's just an actor that doesn't know what it's doing.
Didn't know what it's doing, right?
Right, and so we've had a lot of our companies have to pitch AI off buttons in their product just so buyers got comfortable with what they were selling, which seems kind of crazy.
Right.
You would never be like, well, let me show you how this SaaS product just works offline, right? Because you don't trust the cloud. But that's where we are right now.
Yep. Camille, anything else on the operational and risk side?
Yeah, in some ways this is a standard story. That early stage companies have to prove. They're an unknown entity. Their brand isn't known. We'll get calls from CIOs, why did you invest in this company? And so we, of course, try to support that with our thesis and how much runway we've given them, and we try to give them an extended runway. Somebody said, I think Chris said 12 or 18 months. We try to extend that by double, make sure they have extended time to actually prove themselves. But the truth is it comes down to the founder and the founding team to have a completeness of vision. That's a roadmap, a strategy, an offering. Things like SOC compliance and all the sort of core infrastructure stuff. I do think that most CIOs today, when I talk to them about what's holding them back from deploying AI, it's data governance, and security strategy issues. So we're investing aggressively there. We've got 6 or 7 companies that are solving just to that problem. because we think in this cognitive plumbing era, that's one of the first big milestones or hills that has to be solved. So I guess it's on multiple fronts that we try to elegantly tell the story. The entrepreneur, though, in the end has to be able to capture design wins that become lighthouse customers that demonstrate high impact, high value, not great technology, but great impact. And often, bless the hearts of entrepreneurs, they like to lead with their product, their product, their product. And I'm like, well, let's talk about impact first. Right. Let's talk about business value first. And let's talk about where you went to school and the great tool and the brilliant demo that you're about to do, and talk about the customer's journey to realizing real value out of the equation. So I think that is where trust begins, is make it valuable to me, not to you, your investor, the market, but to my passionate problem inside of my organization. So
Perfect. Well, I know we're out of time. Great panel. Appreciate the conversation. Round of applause. Thanks.